The revenue and collection cycle is particularly significant as it reflects the inflow of funds and the realization of economic value. This cycle encompasses a series of interconnected processes from the initial sale of goods or services to the ultimate collection of cash. The complexities inherent in these transactions, combined with the potential for misstatement or fraudulent activities, make the audit of this cycle a challenge. In today's lecture, we will explore the key components of the revenue and collection cycle, emphasizing the audit procedures necessary to ensure the reliability of reported revenue amounts. We'll address the inherent risk associated with revenue recognition and collection, the various controls in place to mitigate these risks, and the audit strategies employed to assess the effectiveness of these controls. The revenue and collection cycle comprises several interconnected activities that begin with the initiation of a customer order to the ultimate collection of cash. With the initiation of a customer order for goods or services, the cycle begins. Inclusive in that activity is once the order is received from the customer, the credit worthiness of the customer is assessed and the sale is then authorized. Once the sale is authorized, goods are shipped or services are provided to the customer. This triggers revenue recognized in accordance with the applicable accounting standards through the recording of the sale and the applicable accounts receivable. Once customers are billed, payments are received from customers and cash is collected. Throughout the revenue and collection cycle, auditors gather evidence from these key sources to assess the reliability of the financial information reported by the entity. This involves testing the effectiveness of internal controls, examining supporting documentation, and performing substantive procedures to ensure the accuracy and completeness of the revenue reported and the receivables. Recall, the audit risk model is a fundamental concept in auditing that helps auditors assess and manage the risk of making an incorrect audit opinion. The model is expressed through the formula audit risk equals inherent risk times control risk times detection risk. Let's break this down in the context of the revenue cycle. Inherent risk is the susceptibility of an assertion to a material misstatement, assuming there are no related controls in place. For example, if an industry is known for aggressive revenue recognition practices, for example, recognizing revenue before goods are shipped, the inherent risk for revenue recognition in a company within that industry may be higher. Control risk is a risk that a misstatement will not be prevented or detected by internal controls. As an example, if a company has robust internal controls, such as segregation of duties between order processing, shipping, and billing, the control risk related to revenue and collection cycle may be lower. Finally, detection risk. Detection risk is the risk that the auditor's procedures will not detect a material misstatement. In the revenue cycle, an example might be if an auditor plans to rely heavily on substantive procedures, detailed testing of transactions and account balances, rather than testing internal controls, the detection risk may be higher. It's reliable. Auditors must carefully assess industry-specific factors when evaluating inherent risk in the revenue recognition process. For example, industries with rapidly changing product or service offerings like technology or fashion may experience challenges in determining when revenue should be recognized. New products or services may have different revenue recognition criteria or may require new accounting policies. Understanding the nuances of the industry in which a company operates is crucial for designing effective audit procedures and addressing potential misstatements. The complexity and contentiousness of revenue recognition issues can significantly impact the inherent risk associated with the revenue recognition process. For example, when contracts involve multiple deliverables or bundled arrangements, determining the appropriate allocation of revenue to each element can be complex. Auditors need to carefully assess the inherent risk associated with the complexity of revenue recognition issues. This may involve conducting detailed substantive procedures, obtaining third-party expert opinions, and critically evaluating management's judgments and estimates. Revenue recognition often involves management judgment, estimation, and subjective decision-making, which makes it challenging to audit. For example, consider a software company who recognizes revenue from long-term contracts. Determining the appropriate timing and percentage of completion involves significant management judgment. Another area is the estimation of allowances for returns, discounts, and other variable consideration, because this involves assessing the reasonableness of management's estimates. In response to the difficulty of auditing revenue transactions and account balances, auditors may need to perform more extensive substantive procedures. Additionally, they may need to obtain third-party confirmations, engaging industry specialists, and using data analytics, which can enhance the auditor's ability to address the inherent risk associated with the complexity and difficulty of auditing revenue. If prior audits identified material misstatements related to revenue recognition, auditors may need to consider the likelihood of similar issues recurring in the current period. Past misstatements can influence the auditor's risk assessment and the level of inherent risk assigned to the revenue recognition assertions. Further, the auditor needs to evaluate management's actions in response to previously identified misstatements and assess the effectiveness of corrective measures. Inherent risk related to cutoff errors refers to the risk that transactions are recorded in the incorrect accounting period due to errors or mismanagement in the timing of recognition. Cutoff errors can result in financial statements that misstate the company's financial performance and position. Inherent risk related to cutoff is a significant concern in the audit process because it can impact the accuracy of revenue and other financial statement elements. To address inherent risk related to cutoff, auditors typically design procedures to test the accuracy of cutoff by examining transactions at or around the period end. This may involve reviewing documentation related to sales and purchases, assessing the controls in place to ensure accurate cutoff, and performing substantive analytical procedures to identify anomalies. Understanding and mitigating the inherent risk associated with cutoff is crucial for auditors to provide assurance on the reliability of financial statements. Inherent risk related to billing a customer and holding the goods refers to the risk that a company may recognize revenue prematurely by invoicing a customer before the goods have been delivered or the services have been provided. For example, consider a manufacturing company completes the assembly of a customized machine for a customer on December 20th. However, due to logistical reasons, the shipment is scheduled for January 5th of the following year. The company invoices the customer on December 20th, recognizing revenue for the sale. If the company recognized revenue when it bills the customer, rather than when control of the goods transfers to the customer, typically upon shipment, there's a risk of improper revenue recognition. In this scenario, revenue is recognized in December even though the customer has not yet received the machinery. To address risks related to billing a customer and holding goods, auditors typically design procedures to test the timing of revenue recognition. This may involve examining sales contracts, assessing the company's billing and shipping practices, and evaluating the controls in place to ensure proper revenue recognition. Inherent risk related to channel stuffing refers to the risk that a company may engage in inappropriate practices to artificially inflate its sales and revenue figures by shipping excess inventory to its distributors or customers, even when there is no genuine demand. Channel stuffing can lead to improper revenue recognition as the company recognizes revenue on shipments that do not represent bona fide sales to end customers. For example, in an effort to boost reported sales for the current fiscal year, a company ships large quantities of devices to its distributors in the last few weeks of the year. However, these shipments significantly exceed the distributor's normal order quantities. By shipping excess inventory to distributors, the company is engaging in channel stuffing. While the shipments may be recorded as sales in the current fiscal year, there's a risk that the goods are not actually sold to end customers. Instead, they may be stored in the distribution channel or returned to the company in the subsequent period. To address this risk related to channel stuffing, auditors often focus on understanding the company's sales and shipping practices. reviewing sales contracts, assessing the adequacy of disclosure, and evaluating the controls in place to prevent improper revenue recognition. Inherent risk related to sales returns and allowances refers to the risk that a company may experience a higher than anticipated volume of product returns or customer allowances, impacting the accuracy of revenue recognition. Sales returns and allowances are deductions from sales revenue that reflect expected reductions in revenue due to returned goods or concessions granted to customers. Higher inherent risk in this area suggests that there is an increased likelihood of misstatements related to the recognition of revenue. For example, consider a retail company that sells consumer electronics. The company offers a 30-day return policy on its products, allowing customers to return items for a full refund within 30 days of purchase. If the retail company does not have effective systems or processes in place to estimate the volume of product returns accurately, the company will ultimately underestimate the expected returns for a specific period. If the company fails to accurately estimate returns, it may recognize revenue on sales that are likely to be reversed due to returns. This can result in an overstatement of revenue in the financial statements, leading to a misrepresentation of the company's financial performance. Auditors typically perform procedures such as evaluating the effectiveness of internal controls, analyzing historical return rates, and testing allowances for authorization and documentation. Inherent risk related to the collectability of receivables refers to the risk that a company may not be able to collect the full amount of its accounts receivable due to various factors such as financial instability of customers, economic downturns, or changes in creditworthiness. For example, consider a manufacturing company that sells industrial equipment to a diverse customer base. The company does not have effective procedures in place to assess the creditworthiness of its customers before extending credit terms. Consequently, it sells products on credit to customers with a history of payment issues or financial instability. By failing to assess customer creditworthiness, the company is exposed to an increased risk of non-collection. If customers are unable to fulfill their payment obligations, the company may need to write off a portion of its receivables, leading to a potential overstatement of assets and an understatement of bad debt expense. Auditors typically perform procedures such as assessing the effectiveness of credit policies. By reviewing the company's credit policies and procedures for assessing customer creditworthiness, this ensures they are robust and appropriately applied. Auditors will also analyze the historical collection experience, evaluate the adequacy of the allowance, and testing aging of accounts receivable. Occurrence relates to management's assertions that each revenue transaction recorded in the financial statements represents a valid and bona fide sale or service performed by the company during the specified period. A risk exists that a company may overstate revenue by recording fictitious sales that never occurred. This could involve creating fake invoices, shipping documents, or sales contracts to inflate reported sales figures. Companies may also prematurely recognize revenue before the goods are delivered or services are performed, which could lead to improper revenue recognition. For instance, a company might recognize revenue upon the signing of sales contract rather than upon the transfer of control of goods or services to the customer. Completeness relates to the management assertion that all valid revenue transactions and related disclosures have been recorded in the financial statements and there are no omissions. A risk exists that a company may intentionally or unintentionally fail to record certain sales transactions, leading to an understatement of revenue. This could happen due to errors in the recording process, incomplete documentation, or intentional manipulation of financial statements. Another example is if companies fail to recognize sales returns and allowances, thereby leading to an understatement of revenue. For instance, failing to account for customer returns in the reporting period could result in incomplete revenue recognition. Cutoff relates to management's assertion that revenue transactions are recorded in the correct accounting period, reflecting the timing of the sale or the provision of services. The risk exists that a company ships goods to customers in late December, but the sales are not recorded until January of the following year. This misalignment of recording sales can lead to a misstatement in the financial statements for both December and January. In the context of accounts receivable, the existence management assertion focuses on ensuring that the reported receivables truly exist, meaning they represent valid claims against customers or entities that owe the company money at the balance sheet date. The risk exists that a company might inflate its accounts receivable by recording fictitious sales or inflating the amounts owed by customers. This can lead to an overstatement of assets and misrepresentation of the company's financial position. Completeness relates to the management assertion that all valid and relevant accounts receivable transactions and balances have been recorded in the financial statements and there are no material omissions. The risk exists that a company could fail to record certain valid receivable transactions, either intentionally or unintentionally. This can result in an understatement of assets and an inaccurate representation of the company's financial position. The valuation management assertion focuses on ensuring that the reported receivable balances in the financial statements are accurately valued. That is, they reflect the estimated collectible amount. The risk exists that if a company overstates its receivable balances by not appropriately accounting for the likelihood of non-collection, this can lead to an overstatement of assets and misrepresentation of the company's financial position. The revenue recognition principle asserts that revenue must be recognized as it is earned. The Financial Accounting Standards, ASC 606, provides guidance that addresses when revenue is considered earned. Typically, revenue is recognized after the performance obligations are considered fulfilled and the dollar amount is easily measurable to the company. A performance obligation is the promise to provide a distinct good or service to a customer. Essentially, when a customer obtains control over the asset, it is considered transferred and the company's performance obligation is considered satisfied. The company can then recognize that revenue. Effective control procedures in the revenue cycle are essential for ensuring the accuracy and reliability of financial information. These controls help safeguard against errors, fraud, and misstatements in the revenue recognition process. Key control procedures include segregation of duties, divide responsibilities among different individuals or departments to prevent a single person from having control over the entire process. For example, segregating the responsibilities of updating accounts receivable for cash receipts from the actual process of receiving cash receipts is a fundamental internal control measure. If a single individual has control over both receiving cash and updating accounts receivable, there is an increased risk of fraudulent activities such as skimming or misappropriation of funds. An individual might manipulate records to conceal theft. Segregation of duties introduces a layer of oversight. Different individuals are involved in receiving cash and reconciling accounts, making it more difficult for fraudulent activities to go undetected. Other key controls include authorization controls that are implemented to ensure that only authorized individuals have the authority to approve transactions, such as sales orders above a certain threshold requiring management approval. Access controls, which physically secure assets and documents related to the revenue cycle. For example, restricting access to paper documents such as sales contracts and secure electronic files containing sensitive information. Independent checks on performance, which include regularly reviewing and reconciling key documents and transactions to identify and correct errors or discrepancies promptly, or performing periodic reconciliations such as reconciling the general ledger accounts for accounts receivable, sales, and the allowance for doubtful accounts on a monthly basis. Implementing a combination of these control procedures helps organizations mitigate risks associated with the revenue cycle, enhance financial reporting accuracy, and safeguard against fraud and errors. The specific controls implemented may vary based on the nature and complexity of the organization's revenue activities. Let's look at selective internal control and substantive procedures auditors can perform to gather evidence about revenue related to the occurrence assertion. Recall, the occurrence assertion ensures that the recorded revenue actually represents valid transaction. The objective of the test of control is to assess the effectiveness of controls in place to ensure that revenue is only recorded when goods are shipped to a customer. The auditor would randomly select a sample of recorded sales transactions for testing. This sample should be representative of the population of sales transactions. The auditor obtains the sales invoices and related shipping documents for the selected transactions from the company's records. They then compare the details on the sales invoice to the information on the shipping documents, ensuring they match. For each transaction, the auditor verifies that there is evidence of shipment or delivery, such as a bill of lading or delivery confirmation. The auditor also reviews the terms and conditions on the sales invoice to verify that they align with the company's revenue recognition policies and industry norms. If the information on the sales invoice matches the shipping documents and there is evidence of shipment for each transaction, it provides assurances that the control is effective in ensuring revenue is only recorded when goods are shipped. This test of control directly assesses whether controls are effective. By vouching recorded sales to shipping documents, the auditor can confirm that there is appropriate documentation supporting the occurrence of the shipment, which is a key control in the revenue recognition process. This test provides assurance that revenue is recognized in accordance with the company's policies and accounting standards. Substantive test of detail directly examines individual sales transactions to verify their occurrence. It ensures that the company is recognizing revenue for valid sales, supported by appropriate documentation. The test provides assurance on the accuracy of recorded revenue and helps address the occurrence assertion for sales transaction. For example, the auditor would select a sample of transactions from the sales journal. For each of the selected transactions, the auditor retrieves the sales invoice, which indicates the product details, quantity, price, and payment terms. The auditor compares the information on the sales invoice to the recorded transaction in the accounting system and ensures that the terms and conditions are consistent with company policies. Additionally, the auditor verifies the shipping documents, such as the bill of lading or delivery confirmation, to confirm that the products were indeed shipped to the customer. As you probably noted, the tests performed for test of controls and substantive test of details were extremely similar. This is what is referred to as a dual-purpose audit procedure. A dual-purpose audit procedure refers to an audit procedure that serves both a testing of controls and a substantive testing purpose. This approach allows auditors to simultaneously obtain evidence about the effectiveness of internal controls and gather substantive evidence related to the specific financial statement assertions. Dual-purpose procedures are efficient and can streamline the overall audit process. Dual-purpose procedures are particularly effective when there's a logical connection between the effectiveness of a control and the related substantive testing procedure. The decision to use dual-purpose procedures should align with the auditor's risk assessment and materiality considerations. It's crucial to tailor the approach based on the specific circumstances of the audit engagement. Auditors exercise professional judgment in determining the suitability of dual-purpose procedures. The goal is to achieve the necessary audit objectives efficiently and effectively. So in summary, a dual-purpose audit procedure combines elements of testing controls and substantive testing in a single audit procedure. The existence management assertion for accounts receivable is one of the key assertions that management makes regarding the financial statements. It asserts that recorded accounts receivable balances exist. Ensuring the existence of accounts receivable is crucial for the accuracy of the financial statements. If fictitious or non-existent receivables are included, it could lead to an overstatement of assets and consequently an inaccurate representation of the company's financial positions. The confirmation process for accounts receivable is a key audit procedure used to obtain direct external verification of the existence and validity of customer balances. This process involves the independent verification of account balances with the customer themselves. Confirmations can be positive or negative, and the choice between them depends on the auditor's assessment of risk. A positive confirmation is a request for the customer to confirm the accuracy of their account balance directly with the auditor. The customer is asked to respond either confirming or correcting the amount specified in the confirmation request. A negative confirmation is a request for the customer to respond only if they disagree with the stated account balance. The absence of a response is considered as implicit agreement with the stated balance. To obtain direct verification of account balances and confirm the accuracy of recorded accounts receivable, the auditor selects a sample of account receivable balances for positive confirmation. Confirmation letters are prepared, including details such as the customer's name, the outstanding balance, and instructions for responding. The letters are mailed or emailed to the selected customers. The customer is requested to verify the accuracy of the stated balance and respond directly to the auditor, confirming or correcting the amount. The choice between positive and negative confirmations is influenced by the auditor's assessment of the risk of material misstatements and the effectiveness of the client's internal controls. Auditors need to consider the expected response rate and may follow up with non-responding customers to enhance the reliability of the confirmation process. If there are discrepancies or issues identified through confirmations, auditors may need to perform additional procedures such as further inquiry, additional testing, or adjustment of the financial statements. When customers do not respond to requests to confirm accounts receivable balances, auditors must consider alternative procedures to obtain sufficient and appropriate audit evidence. The lack of response could be due to various reasons, such as customers not receiving the confirmation request, overlooking them, or choosing not to respond. Some alternative procedures that auditors can perform include subsequent cash collections. They can monitor subsequent cash collections after the confirmation date. If customers are paying their outstanding balances after the confirmation date, it suggests the existence of the receivables. Examination of shipping documents. It can review shipping documentation and other relevant sales records. Confirming the shipment of goods to customers can indirectly support the existence of accounts receivable. Shipping documents, sales orders, and delivery confirmations can serve as evidence. Auditors may also review any correspondence or communications with customers. Customers may address accounts receivable balances or payment issues in their correspondence, providing insights into the status of the receivables. It's important for auditors to carefully document the alternative procedures performed and evaluate the reliability of the evidence obtained. When customers do not respond to confirmations, auditors need to tailor their alternative procedures based on the specific circumstances of the engagement and exercise professional judgment to ensure the audit objectives are met. The valuation management assertion for accounts receivable is one of the key assertions made by management. It asserts that accounts receivable are recorded at their appropriate carrying value, considering any necessary allowances for doubtful accounts. The relevance of the valuation assertion lies in ensuring the proper valuation of accounts receivable, which is critical for the accuracy of the financial statements. Overstating or understating the value of receivables can impact the reporting of assets, income, and financial health. The valuation assertion is closely related to the adequacy of allowances for doubtful accounts. Management needs to make reasonable estimates of uncollectible amounts and establish appropriate allowances to reflect the economic reality of potential losses. Testing the aging of accounts receivable is a critical audit procedure that helps auditors assess the reasonableness of the allowance for doubtful accounts and the valuation of accounts receivable. The aging analysis categorizes receivables based on the length of time they have been outstanding, providing insights into potential collection issues. Auditors obtain and review the client's aging schedule of accounts receivable. This schedule categorizes receivables based on the length of time they have been outstanding, for example, current 30 to 60 days, 61 to 90 days, 91 plus days. Understanding how receivables are classified based on aging is the starting point for the audit procedure. Auditors will then inquire with management about the process used to prepare the aging schedule and confirm the accuracy of the aging categories. This ensures that the aging schedule is accurately prepared and reflects the actual status of receivables. They will then select a sample of individual accounts receivable balances from different aging categories and perform substantive testing on these balances to obtain direct evidence about the collectability of the individual receivables with each age category. They also analyze the adequacy of the allowance for doubtful accounts in relation to the aging of receivables. They assess whether the allowance is reasonable given the specific risk profiles of different aging categories. This provides insight into the sufficiency of the allowance based on the aging of receivables. Auditors will also review the client's credit policies and terms of sale to assess their appropriateness and relevance to the aging of receivables. This ensures that the aging reflects the credit terms and policies of the entity. They will also analyze historical collection data to assess the accuracy of prior aging classifications and the ultimate collectability of receivables. This helps auditors understand the reliability of the aging schedule based on past performance. By performing these audit procedures, auditors gain insight into the accuracy and reliability of the aging of accounts receivable, enabling them to assess the adequacy of the allowance for doubtful accounts and the overall valuation of accounts receivable. Auditors also typically perform specific procedures focused on assessing the collectability of accounts receivable. They gain an understanding of the client's internal controls over the accounts receivable process, including credit approval, monitoring, and collection procedures. By assessing the effectiveness of internal controls, this helps auditors determine the reliability of the client's estimation of uncollectible accounts. They will also conduct analytical procedures to compare historical bad debt experience, credit loss ratios, and trends in accounts receivable to assess the reasonableness of the allowance. Analyzing trends and ratios helps auditors identify anomalies or deviations that may indicate potential issues with the allowance. Auditors will analyze historical payment patterns of customers, especially those with outstanding balances. Understanding past payment behavior helps assess the likelihood of future collections and identify any changes in customer payment trends. They interview management to gain insights into their assessments of collectability, changes in customer creditworthiness, and the rationale behind the allowance. Management's views and insights are valuable in understanding the basis for their estimation of uncollectible accounts. Auditors will also evaluate the company's policy and process for writing off uncollectible accounts and review documentation supporting any recent write-offs. Assessing the company's approach to writing off bad debts provides insights into the consistency of the application of the allowance. Auditors will also evaluate external economic factors, industry conditions, and changes in the business environment that may impact the collectability of accounts receivable. External factors may influence the ability of customers to pay and impact the overall credit risk. By performing these audit procedures, auditors can gather sufficient and appropriate audit evidence to assess the adequacy of the allowance for uncollectible accounts and ensure that the financial statements are fairly presented in accordance with accounting standards.